How's it going, guys? Welcome back to my channel. My name is Zain Jafrey. I sell properties around the Durham region and the GTA. Today, I have Brandon on with Unbreakable Financial Solutions. Brandon, do you want to take over?
Sure. Thank you for having me, Zain. And we've been meaning to have this talk for quite some time too. So a little bit about my background and who I am. So I'm basically Brandon Benzon of Unbreakable Financial Solutions. I'm basically in the financial literacy space as a consultant and financial advisor. So I have 8 years worth of experience. I started the business very young, actually, did it out of coincidence. Never really dreamed of actually becoming a financial advisor. That's actually like a little bit of my background.
Right.
So background was going to kinesiology and health sciences to study to become a nurse. Well, because I'm Filipino, that's pretty obvious, right? But
Natural transition.
Yeah, and then it was an interesting transition because I wasn't really feeling the program. The career path wasn't really meant for me. And coming to this business, I came into it by accident. Actually, it was a date with a girlfriend and my friend in the mall for prospects and leads, right? Mm-hmm. And he happened to come to me during that time after we finished up our date. And I didn't want to get into this type of sales field because understanding how sort of like financial services, insurance, and real estate, they're sort of the similar aspect of that. It's commission based and it's a lot of talking. And I didn't really have that courage for myself when I first started. I was complete dead introvert. Like me having a conversation like this was impossible. Well, the one thing that really motivated me with money and how my girlfriend was the main kicker to really motivate me to get into this business. And I kind of find it eye-opening where people now these days, they had an advisor, they went to the bank, but not a lot of things are properly explained to them in terms of their current plan for their trades and investments, let alone actually having a certain person or like what I like to say a custodian or someone, the trusted person to hold their hand step by step to be able to show what better options out there, how they can better educate them. So that's what really motivated me to get my licenses, take this thing seriously and help out my core friends and family and my current clientele right now, to the point where opportunities have opened up to do seminars for the Filipino Student Association, or URQ, for not-for-profits, for churches actually, and so much more that I've been able to do in these past 8 years. And recently just getting onto social media. So if anyone wants to follow me on social, I do a lot of my type of style with social media is kind of like Bill Nye and like sketch comedy with education a little bit together. So feel free to follow and for any other details, happy to help out.
And I love your content. And it's a very good point that you brought up. And I feel like in our generation, financial literacy wasn't necessarily taught well in school. And our parents always went straight to the bank for all their solutions. But now with the changing economic landscape, it's more important than ever. And I feel like the younger generation is getting more literate on their finances. And they're trying to save and they're trying to be weary of where their money's going. Yeah. Right. So someone in your space is so important right now, especially because you're very relatable generation-wise, right? And you can really guide us more specifically for our long-term goals.
Exactly, right. And I totally agree with most people. Every time that people typically have the money problem, it's the nearby Scotiabank or TD. It's why? Because it's easy and convenience, right? Yep. But what the actual service? What about the actual time for a certain person to actually sit down with you, and a true story where so much of my clients, they came from the banks, they had advisors that worked in the customer service field, but not actual people to pay attention to them. But in order for you to guarantee that sort of actual one-on-one attention, you need hundreds of thousands of dollars to actually have that one-to-one connection. Right? If you have even just a mere 1,000 or 5,000 or even 10K, you're off to the phone lines, the investor line, right?
Exactly.
The way I view my current clientele, I don't care if you have 500 in the bank or 500,000, as long as if you're really serious in terms of what goals you want to have determined in terms of being able to save for that next house, kind of like we're about to talk about right now. My 100% is given to you regardless, right? And there's so much different types of people, all walks of life. The youngest client that I basically deal with right now is literally just turned 22. The eldest that I currently have right now is around 70. But I really relate to the people that are in that, that 25 to 35-year-old type of age gap, right? In terms of the fact that they want to make sure that they have that properly set. They want solutions. They want an actual, legitimate game plan, no fluff in terms of what it really take to actually get that down payment, and what are some strategy solutions in terms of investment accounts that we currently have here in Canada right now.
100%. And yeah, and it's good that you brought that up because our conversation today is basically going to be based around how younger folks can save up money for a down payment, because with the changing landscape in real estate, a lot of the younger generation feel like they're outpriced or outpaced of the market.
Yeah.
But the truth is they're not, right? And with changing certain financial habits, you can actually guide your way into the real estate market. And we find that a lot of the people that are looking to purchase a property, one of the biggest barriers holding them back is actually the down payment factor, right?
Yes.
And one of the big things is, how can we plan for someone who's looking to purchase a property maybe next year? How can we get them in a position where they have enough money saved up by the time that they're ready to get into the real estate market?
I think the bare minimum is identifying like what property that you're obviously looking at, right? Could it be as basic as like a townhome, a condo, or is something as illustrious, actual like a legitimate home, right?
Right.
And depending where your needs is. I think it's just really learning how to reverse engineer backwards, right? Like if the down payment, like said by like whatever realtor or whatever you set up for that prospective client, say is like $40,000, you really have to think smart and realistic. Like, could you be able to realistically save this within a year, right? 40,000, like 12 months, that's like $2,000-3,000 at best,
Right.
or that you can, be able to like leverage off of other people too. Like in the case of like most people that are like graduating and like about to like get in jobs, some of them like they have spouses, they have like common law partners, right? And the fact that they have to be smart with like their spendings. Like, okay, if I really want to like gun down within like a year of 40,000, then like maybe there's certain expenses that need to cut. Maybe get rid of the the Netflix and like Disney Plus,
Right.
just year like unnecessary cut out on their overall budget, and their primary focus is being able to save for that down payment, right? A true story, a recent client that I have right now, like they just got they just got married. Two, they just moved into like a basement apartment. The wife basically is an executive assistant for a hedge fund company. The husband's a teacher, right? So their primary focus right now is just that we don't want to live in this tiny apartment where like they have a lot of stuff. A lot of stuff.
Right.
How like their whole goal is to like save at least like 50 to 70% of what they currently make. And as long as they have that mindset, knowing the fact that if they do what they got to do, then they can have that certain projection and time frame of at least 1 or 3 years. That's the most aggressive component towards it, right? If you have to really identify like what's realistic for you to be able to save up for that down payment. I do want to go as possible in terms of going through that like that 1 year time frame, or could you give yourself a little bit of grace period of like 3 to 5 years at best? Right. In terms of that, and that's just the bare minimum in terms of what you need to be able to do, and on top of the fact that what more leverage you can develop towards with the investment accounts that we currently have today, right?
No, it's a very good point. And one of the things that I kind of recommend to some of my clients, especially younger folks that are kind of graduating from school or whatnot, is that if you're looking to get into the real estate market, then think about what you would be paying for rent, right? Let's say if you were to not live with your parents and maybe go out and rent your own place, and you're going to be paying $2,000 a month, but because you're living with your parents, you're saving on that money. So maybe start putting that $2,000 a month into a separate savings account. Right now, we can go talk about this a little bit, what kind of savings accounts, but in a year, that's $24,000.
Yeah.
Right. Or if you are currently making, let's say, $4,000 or $5,000 a month, and you're spending $2,000 on rent, then maybe putting maybe $1,000 away, right? So getting more intentional about your saving habits, so you can win in the long run, really.
Exactly, right. And it really just identify what your habits are and what you're willing to put down too, right? And just to elaborate, like that's just the bare minimum in regards to that. Like there's so much different advantages, like having things like the first time home buyers plan with the RRSP, the tax-free savings you currently have, and how the fact that if you make a good enough income, you can have the leverage of both, right?
Right.
Like imagine this: it's like if someone's making at least above 50 to 100,000 at best, like they know for the fact that like they're getting taxed a lot, but the advantage of being able to put money into an RSP is that one, it's tax deductible, so meaning the fact that you get to knock down like your tax bracket by a good significant amount. Two, the fact that you beef up your tax refund into that. So that way, instead of getting, maybe you got like $2,000 for a tax refund, but maybe you're expecting another $2,500, then you'll be able to put that back into your TFSA. And the beauty of both like the RRSP and for the first time home buyers plan and the TFSA is that both accounts are tax sheltered. So meaning the fact that if you put away $10,000 for the whole entire year, see it grow to at least $11,000 within like the next following year, that growth is not taxed. The only difference is
Right.
that with the TFSA is that when money is withdrawn out of the TFSA, it's not necessarily taxed at withdrawal because money is treated as after tax withdrawals. With RSPs, if you decide to move that money out for the sake before retirement, you get double dinged.
Got it.
That's why it's really important to only use your RSPs for the sake of retirement and saving for a home. Because if it's neither for the both, and you want to withdraw that as cash, one, you have to pay 10% withholding charge. Two, you have to pay income taxes too.
Got it.
So
That's not fun.
if you're making $100,000, you draw $1,000, you're losing 30% off of that. But knowing the fact that you're going to use that specifically for the sake of retirement, where your income is going to get taxed less, but specifically in the topic that we're talking about in terms of like being able to save for a home, you could draw up to at least $35,000 tax free, but you have to pay that back to the actual account or quote unquote the government for the next 10 years at least. So at least having the leverage of both, if you make a good enough income between 50 to 100,000, understand the value of a little bit both. Right? The fact that you have these two safety nets, knowing the fact that your goal is to at least save up at least 35, 40,000 within a year, or you can have that 35 grand saved up in the RSP for the first time home buyers plan, or draw that out tax free, pay it back within 10 years, and have a little bit extra to save, because both can come in handy. Like you could potentially use the first time home buyers plan just to prioritize on the down payment. The TFSA is extra regarding like moving costs, being able to buy extra furniture,
Right.
Also, like just basic things you can do, right? And like that's just the account alone. What if you add on like actual investments in terms of actual stocks, mutual funds, and ETFs, and all that type of stuff? And being the fact that like you're basically going for the bare minimum of 35,000 or 40,000, but it could be up to like 45 or 50 if you play the markets right. And another new up we have based on our government is that they're creating a hybrid of both TFSA and RSP combined, called the tax-free first home. Yeah, it's basically a combination of both. It's called the tax-free home savings account. It's a large acronym, but like hopefully they're able to short it down. I swear to God, there's too much acronyms to the investment account just on the side. Right. But the beauty of the account that they currently have right now, it's basically a hybrid of both RSP and TFSA. Whereas contributions are obviously tax deductible, but if you withdraw that money out for the sake of buying a home, you don't have to pay back any the money that's withdrawn out. It's considered to be tax free for the sake of being able to save for a home. And the structure of it, the way proposing, if the budget goes well and everything is approved for 2023, the add-on towards this brand new account for being able to buy your new home is basically $8,000 for the year and $40,000 like total.
Wow.
So $5,000 a little bit more than the first time home buyers plan. So imagine this: you're about to graduate school, you're going to like your brand new job. You'll come 2023, you have options. You can definitely you can, and the fact that both of these three options, the fact that as money grows inside these accounts, they're tax sheltered.
Yeah, 100%. And rather than spending that money on your taxes necessarily, you could kind of move it more towards a purpose.
Yeah.
Right. No, I feel like it's so important right now that a lot of times when we're looking to get into the real estate market, we don't necessarily put our money away. We'll leave it in our checking or our savings account, but we're looking at it. Yeah. Right. And when you look at it, you use it. Right. But in the case of like a tax-free savings account or an RRSP or this new program that's coming out, you're kind of really making your money work for you. Yeah. You're being so intentional with your thought that this money is specifically for this purpose. Right.
100%. Yeah. 100%. The term that I like to say is like, those are your sacred accounts. You do not touch those money for the sake of emergency, right? For this next 2 basically strapped for cash, and your focus is that down payment, right? And the fact that if you work with a good advisor, if you have good discipline and habits, then you learn how to have a budget, live below your means, right? Making sure that you don't go out as much within these like 1, 2, 3 years, whatever time frame. You realistically want to have that down payment too, right?
Yeah. And the best part is that someone that's coming out of university, they might be coming out with a degree or a job that pays them $40,000, $50,000 a year. But if they start intentionally saving for that down payment, by the time that they're prepared to buy a home, maybe 2 years later, that $50,000 has been bumped up, right? Because they've gotten a couple of raises to that point. So now maybe they're making $80,000, right? So now they qualify for more on the loan side. Plus, if they were intentional with their savings, their down payment's ready to go, right? Rather than starting the process when you're making more money, it's kind of like you're starting the process from the get-go.
From the get-go. It's no different than going to the gym, right?
No.
Like as much as we want Arnold Schwarzenegger, you know, like Rocky Balboa body, like we don't start with the 100-ton weights. You kind of go like have to start with 10 to 20, right?
Yep.
Especially
100%.
exactly right. So like even if you could just start off with like 200 or 500 at best, whatever your financial are, knowing that if you're that ambitious in terms of being able to get a raise, do a couple extra side Uber, whatever the case may be, to like squeeze extra cash to be able to put into eventually be able to gradually get out into those higher amounts as well.
Yeah.
A true story. A true story for a client of mine's, like for the longest period of time, like he worked in a warehouse and like factory. And for the past like 4 or 5 years, he could only afford doing like $50-$100 contributions. Then he got a raise, and then pandemic happened, and he didn't have to travel around as much. He started to be about the contributions to 500 to 700 at best. Right. Because it's just being able to the fact of being able to work yourself into the fact that, you know, you start a gradual amount that you start off with, and you'll be able to build upwards as well.
Yeah. It's a very good point that you brought that up, because sometimes the conversations that we're having with our prospects that are looking to get into the real estate market maybe in the next year or two is, should we put a fixed amount every month, or should we go on like a percentage of our income? Right. So if you make
it could be, it depends. It could be a bit of both.
Right.
If
what's
it's
more
really
consistent for you? What do you think is more consistent?
I feel that for me, it's been more basically percentage in terms of like what it will, and like that's where that second conversation and me showing everything on the Google, like in terms of like my proposal to them, showing like this is what it would look like if you save 20% of your income for the next like 2-3 years versus or they're really serious in terms of their goal, that $40,000, you know, like this is what it would really take within that fixed dollar amount, right? Like I find that based on the current clientele that I deal with, it's been a bit of both, right?
Really?
Some of them they're really serious and say like, I don't want to be in my mom's place anymore. I don't want to be in this tiny little like like some of them, they're ambitious. They just like, okay, I'll stick to that dollar amount. I'll just do my best to be able to adjust and all that, right?
Yeah.
Or some of them, percentage as well too.
Okay. Yeah, I've had some situations where like it's a couple and they'll literally be living off of one individual's income and they're stacking the rest.
Yeah. So then that's
the best.
Yeah, that's the best, right? Yeah. So like one is like, that's my current client right now, right? We're secured, but like whatever extra money that she currently has to just stacking on towards it. And basically the husband's like matching whatever she currently has to be able to make sure that they have a fortunate amount within the next like 3 years or so. So yeah.
And I know it's kind of an awkward conversation for some couples, but when one individual is making a little bit more money than the other, it's kind of hard to match, like let's say $500, each person's putting in $500 to that specific fund. But in that situation, you can really go on the percentage model, right? So maybe like 10 or 20% of the income for that month, each person could put in like 20% rather than a fixed fee. Because if one individual is making a little bit less, it's harder for them to put, because it's a bigger chunk of their paycheck, right? And at the end of the day, it's still getting you to the same space, the same exact spot.
Exactly, right? It's just an alternative route, but it's still to the same destination regardless.
Yeah, 100%. No, I feel like this conversation is so important. It's so overlooked. And unfortunately, there aren't many financial analysts, especially like financial advisors. When you go into the banks, they're not that useful. And that's why it's so important for someone like you, right? Where you're kind of working around the clock and you're guiding someone's financial plan is being specifically made for them, tailor-made. Whereas in the bank, it's a lot more just, here you go. Here's some pamphlets. Read them. Let me know what you want to do.
The way I describe going to the bank for any type of investment or financial advice is like going to a Baskin Robbins that sells one flavor.
Yeah, literally.
Literally one flavor. Like they sell like the most like ridiculous, like blueberry rhubarb. Where's my Rocky Road? Where's my chocolate? Where's my vanilla? Right? And like that's the problem with most now these days, because they make money off of their name brand mutual funds in terms of the fact that they create it, and like obviously they want to like turn over a profit, right? Versus what they would make less in terms of recommending another fund, in terms of the fact that they you know it's brokered from another industry and so forth, right? Or another firm. But for me, like I have my investment license through my firm that has their own name brand mutual funds and the investments, but knowing the fact that I have access to 10 different firms, I still get paid one and the same.
Mm-hmm. Exactly. So you're really looking out for their best interest.
100%.
Yeah. So let's just recap. So let's say if I came up to you and I'm making $50,000 a year, right? And my girlfriend's making $50,000 a year as well. And we're looking to buy our own place, maybe let's say 12 months from now.
Yeah.
What would you recommend that, how do we start saving? Or like, what should we do with our money?
So it's the fact that like if both of you make 50 and 50, have a compounds approach more towards the first time home buyers plan and TFSA, right?
Okay.
If both of you can afford doing like basically like, you know, you can do $2,000 if afford to do that for yourself, and she could do 2,000, then you know I'll be able to split that up a little bit more towards. So 1,000 will go towards the RSP.
Yep.
And then we'll go towards the TFSA.
Oh, because you're putting in both.
But have it even both, right? And knowing the fact that like, you know, even if you do like, you know, you're making 50, you make $12,000 a year in contributions to the RSP, you get to write off $12,000 in terms of your income.
Beauty.
Right? So instead of reporting to the government 50, just like, haha, I don't make 50, you tax me 38.
Got it.
Meaning the fact that you save yourself, that bumps up an extra like $200, $500, or potentially $1,000 for your tax refund. And you know that can add an extra to the TFSA on top of the fact that you have the gradual habitual, you know, extra, you know, $1,000 a month if you're able to afford it to TFSA as well.
Yeah, and I know to someone watching, it might not seem like a lot, or it might not seem like it may be worth it, but it actually makes a huge difference because now you're getting very intentional with your money. It's actually saving you on the tax end as well. So it's literally a win-win.
A win-win.
Because
another thing to also look into. Look at birthdays. Look at like certain cultural families, Chinese people specifically. Like, you know, the red envelopes come.
Yeah,
you know, going towards too, right?
Exactly.
Like anything to get to squeeze as much cash as possible, any opportunity to do so. Apart from making, like if they have a side hustle, if they do Uber Eats, if they receive bonuses, if it's paying less taxes and getting more for the refund. It's just so much different options to be able to do it within the next 12 or 24 months if they're really serious to move forward in that direction.
Yeah, and a big takeaway too is that don't necessarily just put it into your checking account or your savings account. Really get intentional with that money and make that money work for you, because it's not doing anything just sitting there. Yeah. Right. So rather put it somewhere into like a TFSA or a RRSP.
And let that money intentionally grow, because like there's been so many times where, you know, no offense to the banks, right?
Yeah.
That and like because of that lack of that one-to-one attention, like they put it in a checking account, they put it in a savings account, but it's not moving, right? And the fact that you keep it in something that basically performs at 1% when inflation's at 4%, so you're basically losing money.
Yeah, that's so true.
Yeah.
Yeah. I know we had a little bit of a conversation before as well about insurance.
Yeah. So when you do get to the chance of actually moving into your place, the most important thing to have is having life insurance. Because the fact that you moved into that place, you committed to that down payment, you have this $300,000, $400,000, $500,000, or even $600,000 mortgage. That's a burden that you carry, and obviously, God forbid, if you're the main breadwinner of the family amongst like the couple or the family, you know that's a $300,000 to $500,000 burden put into their hands that eventually someone else. So it's so important to have an actual form of I prefer term life insurance, right? Where it's cheaper for someone that's literally like 20, like under the age of like 25, they're paying like peanuts worth of the dollar or pennies worth of the dollar, right? And the fact that like, you know, God forbid is something were to happen to you, you know, on a untimely death, at least your the mortgage is covered for. At least a legacy is given towards your family, and that death benefit that's given towards that life insurance policy is tax free, right? And how there's so much different options in having life insurance. Some policies offer actual additional benefits. Let's say you're driving, you get hit on the 401, working, you're disabled. Some policies you to waive the monthly costs in the case of you actually qualify for disability. Some policies, the one that I provide for my current clientele, if they get terminally ill, let's say they get cancer, tuberculosis, or COVID, right? In that case, they're given their last days on this earth. If they have like $100,000 policy, they could cash out 40% of it and use it as literally as a tax. They can cash that out tax free, and you know, for that 40,000 that they can use it for the sake of travel, pay off debts, like or add on to their initial mortgage, give as a donation to a loved one, and that 60,000 that's obviously left over is meant for the sake of using a death benefit.
Wow!
So there's so much different options. So that way, like when it comes to committing to your like one's clients or your journeys to like be able to real estate, there's a way to play offense in terms of being able to save and making sure that you're using the right type of habits, ensuring the fact that you the right amount currently used, and the fact that you're using all these other investment accounts. And there's defense. God forbid if you die too soon, you actually have proper forms of life insurance. Because the problem existing now these days is that the most common type of insurance that's being sold for most people when they move into their homes is mortgage insurance. And how it's managed with most banks, because the major flaw behind it is that your beneficiaries are not the beneficiaries of the banks.
Interesting. Wow.
And then and like CBC, they did a whole expose behind it 10 years ago actually, about how they weren't properly like clarified on like the details of their current policies, right? That majority was more of the beneficiaries. Another crazy fact was that there's not much proper underwriting behind it, right? Because I think as was mentioned from before, that like we're the key thing is that with actual life insurance, underwriting or background checks typically done twice. At the time that you basically are about to set up yourself to the policy, you do your background questionnaire, you do the medicals, and the time that you actually file the claim, right? To make sure that everything that was basically said from the first process is true to the second process. With mortgage insurance, they skip that. It's called post-claim underwriting, and how they basically it doesn't matter the fact that like you're coughing blood or you got cancer, regardless of your health condition, you'll be able to apply for it. But when they actually do the actual medical report, there's been a lot of people from that CBC documentary that were declined.
Wow.
And how a real story, Zain, was that when I was going through my training, there's been real life cases where people like they got through to getting the $300,000 mortgage insurance, but because of a certain slip up in their medical questionnaire, they got declined for the time that they filed.
Wow.
So it's important to have actual life insurance rather than insurance that the banks sell.
Yeah. So I guess like it's good to be, I guess the whole takeaway from this whole conversation is good to be prepared, in a sense, right?
You fail to
be intentional with every action.
Exactly.
Right?
Yeah.
Wow. All right, guys. Thanks for watching. Thank you, Brandon. Guys, I'll post Brandon's link on the bio below. So if anyone wants to reach out, please do. He's an amazing financial guru to talk to. And him and I do work very closely together for various clients, and it's always great to talk to someone. I would say in our generation, the things that we talk about are so much more applicable to our own scenarios, and it's the same scenarios that I know so many other people are going through as well. Right? Any finishing comments?
Just make sure to prepare.
Yeah.
Just again, like kind of the theme that we talk about, be intentional with the thoughts and actions that you do, especially being able to save for a house. And for anyone that wants to follow my educational juicy content as well, feel free to those too.
I love his Instagram videos. All right, guys, take care.